All right, let's talk about financial alchemy. We're going to dive deep into the world of high finance to understand some of the most powerful and, complicated tools ever invented. We're going on a journey to see how you can take something incredibly risky and magically turn it into something safe. And maybe, just maybe, even create risk out of thin air.
And it really all starts with this one big puzzle, a question that totally obsessed the financial world for years. Can you take a giant pile of risky loans, think subprime mortgages, and through some really clever financial engineering, turn them into a super safe, top-of-the-line asset? I mean, it sounds impossible, right? But the pressure to solve this puzzle was absolutely immense.
So, to get why this puzzle even existed, we have to start with a really fundamental problem in the global economy. And that is a massive, and I mean massive, unmet demand for safety.
You see, you had these huge financial players. We're talking money market funds, big investment firms, sometimes called shadow banks because they operate a bit outside of traditional banking rules, and they were sitting on just enormous piles of cash. Now, to protect that money, they needed to park it somewhere incredibly safe, like super high-quality government or corporate debt.
Well, here's the rub. The global demand for these ultra-safe assets started to completely outstrip the supply. There just wasn't enough top-tier government and corporate debt for everybody who wanted it. So the financial industry had to get creative. They had to innovate.
Okay, so let's jump into the first big invention they came up with to solve this shortage, a process called securitization.
In plain English, securitization is basically a way for a bank to take thousands of individual loans, mortgages, car loans, whatever, get them off their books, package them all together, and then sell them as a totally new, tradable security to investors on the open market. The whole process really works like a financial assembly line. First, the bank pools all the loans together, then it sells that bundle to a special fund. That fund turns around and issues bonds to the market. And the investors who buy those bonds, well, they get the cash flow from all the original mortgage payments. This is great for the bank because it frees them up to make more loans, and it creates brand new stuff for people to invest in.
But here's the catch, and it's a big one. The new security you just created is only as good as the loans you stuffed inside it. So if you bundle a bunch of really high-quality prime mortgages, you get a safe asset. But if you bundle a bunch of risky subprime mortgages, well, you just get one big risky asset. And that doesn't solve our original problem of finding safety.
So how do you actually create a safe asset from a pile of risky ones? Well, this brings us to a much more powerful and way more complex invention, the collateralized debt obligation, or CDO.
Okay, the best way to think of a CDO is like a risk-sorting machine. It takes a whole mixed bag of assets, mortgages, corporate loans, you name it, and then it slices and dices the combined risk into different layers. And in the world of finance, they call these layers tranches.
And it does this using what's called a waterfall structure. So imagine all the money from the loans flowing in from the top. The senior tranche at the very top gets paid first, and it's the absolute last to take a hit if things go bad. The junior tranche is in the middle, and way down at the bottom, you have the equity tranche. It gets paid last, but, and this is key, it absorbs the very first losses, acting like a shield or a buffer for all the layers above it. So here's the magic trick. Because that senior tranche is so well protected by everything below it, it can actually get rated as a top-tier, low-risk, super safe asset. It's exactly what those shadow banks were desperate to buy. And this can be true even if the entire CDO is filled with risky loans. That's financial alchemy right there.
But yeah, that wasn't the only way to turn something bad into something good. Another method was a lot simpler. You just take a risky asset and you insure away the danger.
And this is where the credit default swap, or CDS, comes into play. It's basically an insurance policy on a financial product. The person buying the CDS pays a regular fee, a premium. And in exchange, the person who sold it agrees to cover all the losses if the asset, let's say it's a bond, defaults. And you can really see the transformation right here. On the left, you've got a risky subprime bond. High risk, but also high potential return. Then you slap a CDS contract on it, and poof, it suddenly starts behaving like a safe prime bond. The risk is just stripped away and handed over to whoever sold the CDS. Of course, there's no free lunch here. The investor gets that safety they wanted, but they have to use that extra juicy return they were getting from the risky bond to pay the insurance premium. So in the end, they're left with a lower, safer return. They've basically traded both the risk and the extra profit to the insurer for some peace of mind.
Okay, so far, we've seen how these tools can manage risk, reduce it, shuffle it around. But here is where it gets really mind-bending.
they can also be used to create risk, synthetically, completely out of thin air.
This leads to a really wild concept. Think about it. You would never buy fire insurance on your neighbor's house, right? That'd be weird. But in finance, doing the equivalent is actually pretty common. You can sell a CDS, that's insurance, remember, on a pool of mortgages that you have absolutely no connection to. And at that point, you're not just transferring risk anymore, you are creating a brand new bet on whether those mortgages are going to succeed or fail.
Let me show you how this works with something called a synthetic CDO. Okay, so picture a fund that only buys super safe government bonds. It's a very secure portfolio, but let's be honest, it earns a very low, very boring return.
Now, to juice its returns, that same fund decides to act like an insurance company on the side. It starts selling a credit default swap, promising to cover the losses on a totally separate portfolio of risky subprime mortgages that belong to someone else entirely. It doesn't own them, it just insures them.
And what you get is this incredible synthetic creation. The fund is now collecting two different income streams. It gets the small, safe interest from its government bonds, plus the big, risky premium from selling the CDS. And by doing this, its portfolio has synthetically taken on the exact risk profile of the subprime market. It has created a high-risk, high-reward asset without ever actually owning a single subprime loan.
Which really brings us to the final big question. This kind of financial alchemy, it's undeniably brilliant. But are these instruments really ingenious tools that help spread risk around the system in a healthy way? Or are they a hidden danger, a way to create and hide risk in corners of the market that we don't fully understand? I mean, that is the multi-trillion-dollar question that sits right at the heart of the 2008 financial crisis.